All right, everyone, welcome to another Altos Trading Live Strategy session. This is Richard Van Rich here with Jeff Tompkins, and we got Craig Ward in the chat. Well, we got a lot to go over today. It's pretty crazy, impactful events happening in the market right now. And as usual, these live sessions we do are pretty timely. So really excited to have you guys with us here tonight. Got a lot going on. This is your first time on one of our sessions. You'll notice your microphone's muted. That's so we can hear Jeff talk. If you have any questions at all, you can put those in the Q&A box. You'll find that at the bottom. And that way, Jeff and I can see those and ask questions periodically throughout the session. If you have to hop off for any reason, don't worry. This is recorded and will be available in the members area later tonight and also on YouTube. So if you haven't, please like and subscribe to videos on YouTube so you can get all the new sessions posted there as well. Before I bring on Jeff, let me just read a disclaimer. Trading securities and options involves risks. Prior to buying and selling an option, investor must receive copy characteristics and risk standardized options. Investors need a broker to trade securities, and options must meet suitability requirements. Past results are not necessarily indicative of future performance, and performance figures are based on actual trades, including real money results. Due to the time-critical nature of trading, broker fees, and activity of other subscribers, there's no guarantee that subscribers will mirror our performance. And performance numbers shown are based on trades users could enter based on the trade signals. So speaking of, so if you have any sort of questions about your account, access to Trade Trend, Zillion, anything like that, email support@Altos Trading, and we'll address anything specific to you tomorrow. With that being said, let me hand it over to Jeff. So Jeff, if you want to grab the microphone.
All right, thanks, Richard. Welcome, everybody.
Yeah,
it's a big week.
That's good timing, isn't it?
Oh man, yeah, this is a big week. So we had a big reversal today, and we're going to look at that. But big day tomorrow with the Fed meeting. So as we get into that, I'll elaborate more. But a lot of this has been priced into the market. So there's the potential for a surprise. There's a potential that something might not happen the way that we anticipate that hasn't been priced in. So we need to be prepared for that. But I think that aside from that, that's been priced in. What really hasn't is the Russian-Ukraine war. So that's something that's, I think, going to continue to impact markets. But what we're going to cover as it relates to some of these things that are happening this week are, number one, the Fed decision and interest rate concerns. So those have been lingering. We know that to some degree of certainty that there's going to be a number of interest rate hikes. It's just a matter of the timing of those and how long it takes for those to play out, and whether they're kind of evenly spread out, or we see periods where there's a higher rate than expected, and that's what could kind of derail any sort of rebound in the market. And then, of course, geopolitical risks. The war is obviously something that really has impacted the market on a kind of more of an emotional basis. But in terms of how it's going to impact, commodities, and which it of course has, but other things that have an effect on our U.S. stock market, that's going to be to be determined and probably priced in as it plays out. And then obviously we want to spend some time tonight looking at what you guys are interested in, what you're following and tracking as far as equities or commodities or currencies. Currencies have been obviously very volatile too at the moment due to all of this. So we'll make sure to leave enough time for that tonight. And then of course wrap up with a Q&A. So Richard, if you want to flip off our cameras, I'm going to go over to our platform here. Okay, so Richard actually just pointed this out to me. It's something I watched, but I haven't really paid attention to a lot as of late, because and and this, so what this is a 50-day moving average, the blue line, and the 200-day is the red line, because obviously they, over such a long period of time, they've been upward sloping and either somewhat parallel or diverging with brief convergences. But something interesting happened here that is referred to as the death cross. So when the 50-day moving average crosses below the 200-day moving average on a daily time frame, that is often considered very bearish. Of course, we know that moving averages are lagging. The sell-off, starting from back at the beginning of the year, is just now really showing up in the moving averages with a 50 period and a 200 period setting. So that doesn't mean that the market won't go back up over the near term, but it's something we don't see often. So something that we need to pay attention to, and the way to really look at that is divergence. So with moving averages, we want to see them move away from each other, and with a 50-day and a 200-day moving average in this event of the death cross, we want to see that these start to diverge, but both we want to, for really, I guess, good confirmation, we want to see them both sloping down. Right now, the 200-day is flat, and the reason for that is that it's taking past price into consideration when we were making big upward moves in the market, and being it's a longer term moving average, it's going to react more slowly, and of course the 50-day is going to react more quickly, and so that's why we're seeing this. But right now the 200-day is flat, with the 50-day sloping down, and these really should be used in the context of where price resides relative to the average. And right now we're very far away from those. So I don't use moving averages by themselves to really make any trading or investing decisions. I use them in combination with horizontal support and resistance levels, volatility studies like the Bollinger Bands, and momentum studies like our trade trend indicator. So I want to really look at those in the context of confluence and how all of these things are working together. Certainly not necessarily, moving averages are not necessarily a good standalone indicator. I think they need to be taken into, put in context. And as price moves away from these, of course, there's a higher likelihood of what's referred to as a mean reversion. So at some point in time, the price will revert back to the mean. What makes that a bit of a challenge in terms of using it as an analysis tool is the mean itself is, and that's why they call it a moving average, constantly changing. So right now, for instance, the 200-day moving average on the S&P is around 44.67, while the close on today is 42.62. So it's a long way from the 200-day mean, but and it will eventually revert back to that, but the mean's not going to stay at that price, right? So that's why it's should be taken in context with other indicators and studies. But something more, it's noteworthy. It's something to consider. It doesn't happen often. Let's see if I zoom out in time, go back 15 years. Right, we haven't had one since the Corona crash. Of course, that was a brief one, and this is why I stressed we want to see these really both sloping down in the same direction to give us a longer term picture of price. Because what happened here with the 50-day average, of course, being reacting more to recent price changes than the 200-day, it slowed down very quickly, and we never saw the 200-day go parallel to the 50. That's what's going to give us the better picture of, the better long-term picture of a bear market situation, I guess. And so it's premature to make that call based on the moving averages. And that happened here too, back in late 2018. So the 200-day never went parallel to the 50, and same with later back in 2015, 2016. So typically, if the 200-day remains slightly downsloping, parallel, or definitely upsloping, then there's a higher probability of a rebound back above, well, I guess we could say of the 50-day crossing back above the 200-day, and then a subsequent rebound and a sustained rebound in prices or trend to the upside. That's what we're going to want to really watch for. So until that happens, we want to take into account the real possibility that this is a temporary or short-lived cross, and that the 50-day could quickly reverse back to the upside and then cross back above the 200-day moving average. So, but certainly, something to pay close attention to, and of course, being that they're lagging indicators, especially in a significant or sell-off with greater magnitude that happens rather quickly, that happens before the cross happens. So, like back during the Corona crash here, we see the sell-off. Cross didn't actually happen until after the rebound started. So, I guess the takeaway is you don't want to be trapped by thinking that this cross is going to be sustained. We won't know that for a while. So that's what I want to emphasize, is that we want to wait to see if the 200-day, the red line here, is starts sloping down to match the 50-day and runs relatively parallel to it. And then that's going to tell us that there's a greater likelihood of a medium to longer term downturn in the market. Okay, so enough about that. I'm gonna actually take those off. Oh, I guess I have them on studies. That's right. Okay, so then let's map out levels. Let me go back to our 1 year. So what's significant now, and we have to really look at this in the context of what's happening tomorrow with the Fed meeting. So the expectation is a quarter basis point rate hike, and in terms of probability, that's the most likely thing to occur, and that's been priced in. That's what's expected. I'm sure there's still going to be volatility leading up to the announcement, and probably even after the announcement through the close of trading tomorrow. But it's still priced in. So what would cause a surprise or greater than expected volatility? And that's the topic of our session tonight, is how to read the implied move. So I'm going to focus on that and show you how to do that. Options markets price in expected moves based on events, announcements. The only thing obviously they can't price in is something that's unforeseen, like a black swan event. But when you have a major Fed announcement or a quarterly earnings release or something, that's going to be priced into the expected move. So it's helpful information. So we're going to look at that here in a minute. But looking at levels, there's a strong level down here around 4150 to 4200, and that's so far served as let me get my drawer up here. Really strong support. Okay, and maybe even rather than call it a level, refer to it more of a zone. So, and the real wide zone is 41. So my anticipation is we're going to see some degree of a near-term rebound, and I'll explain why that is. And what could derail that, of course, is if the Fed gets more aggressive and they're hawkish and they decide inflation's out of control. We really should do a half basis point rate hike, and that would be unexpected in the context of the conflict with Ukraine and Russia, because if that wasn't happening right now, it would be much more likely they would be more aggressive. But they're more likely to be cautious tomorrow and kind of take the middle road, because it could really damage the market if they were to go a half basis point increase in rates to try to dampen inflation. So if that occurs and everything goes as expected, based on price action today, because we got bullish reversal off the 4,200 level, then there's a chance we could see a near-term rebound in the market. So this leg right here that almost made it down to 4,100 was major support from back in May. So there that you see on the left side of the screen, and we've been able to stay above that level for a while now, right? So there's a bit of a rebound up into the 4,400. We talked about that in our last session. A continuation of the sell-off down into around the 4,150 level, the half century mark there, and that level is now holding. So we now have two levels, major levels, that are holding, and paying attention to price action the day before a major announcement like a Fed meeting is extremely important, because it actually is telling us what the so-called or quote unquote smart money is doing and looking at and expecting. So that doesn't mean there can't be a surprise and a reversal, but this wave here that then moved up into the 4,400 came back down. So far on the S&P has not retested this 4,100 level, and so if we move up off of it, it's more likely that the minimum retest 4,400, and if that breaks, this downturn that we've been in could temporarily go back above 4,400. I think because the Russian-Ukraine conflict is not well priced into the market, that there's still a lot of risk to their overall markets, and that there's really at this point I don't see us getting back up to 4,800. So as in the near term, for the remainder of this weekend into next week, if this 4,200 level holds, then look for major major resistance at 4,400. And then our next major level of resistance is at 4,500. So those are if this this rebound that we're seeing right now actually follows through, that's what we're looking at for resistance. And let's see here. Yeah, so 4,400, 4,500. So if I'm looking at any long positions, and I am ready to go in long on the indices if tomorrow this 4,200 level holds, but I'm keeping position sizing very, very conservative, very small, because there's a lot of risk in the market right now. And if I do take long positions, I'm watching the resistance levels very closely. So again, 4,400, 4,500. And that's where I would be looking to take profits if the S&P gets back up to that level. All right, so any questions, Richard?
Someone just typed in, could we see a possible complicated head and shoulder pattern forming in SPY?
Let's see. I mean, SPY is going to look almost identical to SPX, but yeah, I mean, so the head and shoulder is there, but let's see. I mean, right, so left shoulder, head. I mean, and this is the quote unquote complicated head and shoulder, but this left shoulder wasn't met with a right shoulder. So then we want to really be looking at the 455 level is our shoulders. The neckline is right about here. So he broke below. So that, again, that can serve as resistance, which is why I'm really waiting for the dust to settle tomorrow to see what price action dictates in terms of upside and downside potential.
Yeah, they had a follow-up saying what they meant to say was an inverse head and shoulder.
Oh, yeah, that could also be. Yeah, so we could have, and probably likely actually, right? So we could have, head, left shoulder, right shoulder, at least for the near term, definitely. So that's why those levels that I mapped for you, let's go back to the SPX, are so crucial to watch, because really that's what that support level was. Right, 4,200. So, I mean, here's my call is based on what happens tomorrow through the rest of the week, not just tomorrow, through the rest of the week. Because this is very bullish price action, right? A lot of volume, wide range, so the bears had almost no control today. The open was at 41.88. The low is at 41.87. So we're only like a point below where it opened, and it gapped up from the close of yesterday due to overnight futures trading, and it closed near the high of the range. So very bullish. As we approach a major announcement tomorrow. So right now, very near term, it's bullish, and through the remainder of the week, we want to, if this bullishness from today is negated, if all of a sudden a bunch of selling pressure comes into the market and we start going back below the low from today, then it's a very very high probability we're going to see a retest of the low from back in late February into 4,100, and then that's where we're going to be watching to see. Because that's our support level to watch 4,100. I wouldn't use the low from this day because it was at 41.14. I really want to see a sustained break of 4,100. Then I'm very, very bearish. I'm already bearish right now, but if this buying pressure follows through, yeah, I think we could be looking at upward moves into the 4,400, 4,500. 4,600 much more unlikely, but possible. But again, there we've got very, very, very strong resistance, and I can't even think of something right now that could be a catalyst to propel prices back above 4,600 for now, unless something major changes. But the good news is, for those of you who are maybe just go long or hold a portfolio of long stocks or whatever. For now, it seems this is a base in the S&P. And actually, let's look at the peak to trough sell-off real quick. Let's calculate it from, let's see here.
I can learn to.
Oh, I don't want that. There we go. All right. So again, high from all-time S&P high from early in the year was at 48. We'll just call it 48.18. In the low from the 24th was 41.14. And we divide that into the 48.18. All right, so yeah, so peak to trough sell-off is rounded up 15% on the S&P. It's greater on the Nasdaq. I think we did reach bear market on Nasdaq, which is a 20% peak to trough. But we're not in a technical bear market scenario with the S&P yet. So if this can hold at least through the end of the week, that might be a good indicator that we'll see near-term rebounds into these resistance levels that we mapped out. So let's look at the Nasdaq real quick, and then we'll look at the VIX, and then I want to show you guys the implied moves. So also same thing on the Nasdaq, which leads me to believe that we have a likelihood of a rebound here. So 13,000 major level. So we've got, and anytime when you draw these levels out, that's not the end of the process. So that's the first step. But the next crucial step is to look at what happened off of those levels in the past. And what I mean by that is, look at the magnitude of the move from that level. So from back in early May, there was huge buying pressure off that level. This of course is now a resistance level, but 14,200, huge buying pressure off that level. And that's why this day in mid-February, there was so much, look at the range on that day. There was so much buying pressure off that 13,000 zone because of there was buying pressure at that level before. And now we're seeing it again, right? So we sold back off into that level, and then buyers came in and pushed prices off that level. So this level at 13,000 on the Nasdaq is holding very, very well so far. If it breaks, we want to be cautious of this. It's kind of like around the 12,700 level. That would be our next area of support. So we have a couple strong levels of support on the Nasdaq. So they're from back in April. And again, look at the move off that level. And then even though there was a significant sell-off, it never came back down. Instead, it found support here at that 13,000 level, right? So 13,000, very, very strong on the Nasdaq, and could hold through this Fed announcement and push prices higher. So then, if we were to take a long position in the Nasdaq or tech stock that trades on the Nasdaq, then we want to obviously be watching for resistance. The one problematic thing here is there's a very strong resistance that's not too far overhead. So there's our resistance right around 13,700. So we want to, keep an eye on that. You can see it. There was the support. You want to see a level serving as both support and resistance, not just one or the other. You want to see it for it to be really a strong level. You want to see multiple touch points at that level and reversals off of that level. And you want to see that happen, several times at least. If we can get past that level, there's again more strong overhead resistance. here. And then here's another one. So we've got a lot of layers of resistance to get through on the Nasdaq. So medium to long term, you know, there's a lot of bumps in the road there that we may not be able to get over. Near term, through this week and the next week, 13,000 seems to be holding pretty well. So for now, until our session next Tuesday, keep an eye on the 13,000 for support and the 13,700 for resistance on the Nasdaq. And then we'll look real quick at the VIX, see what it's doing, and then I'll kind of show you how we can look at the implied move in the market over the near term to give us some idea of where our support and resistance also holds, and if that implied move breaks on a major announcement like FOMC meeting, then there's a better likelihood that it will be a sustained break, because generally once an implied move is what's the word? It's not respected. So it's like it moves outside of it. The market has decided that implied move was too narrow. Then that often results in further momentum past that implied move. And then so on the VIX, we are finding strong resistance. And this also is an indicator to us that the near term, this sell-off is losing steam. As we retreat in the VIX. But as I mentioned in our last session, this is no longer a VIX spike like a lot of these that you see on the chart. VIX spike, VIX spike, VIX spike, right? Where you get a lot of temporary fear in the market and sell-offs that's just quickly met by buying pressure that drives prices back up. And that's what you're going to see most often under normal market conditions. But what's different here is the VIX spiked above 20 there. It came back down pretty quickly, but the 20 level held. 20 level holds, find support there. That's always a sign. If you see a VIX spike, because see on these other ones, the VIX, that 20 level didn't hold. So it came back down below 20, came back down below 20, back 20, 20. All these that come back down below 20, that's basically just telling us that was a temporary sell-off. And those are situations where there are good opportunities to buy. This is, to me, is not a good opportunity to buy medium to long term, because after this VIX spike, we did that 20 level hold. We did not go back down below 20 other than for one day, and quickly spiked back up and came down and spiked up. It's getting a little messy, sorry. But basically, volatility is holding, which tells us that market sentiment and conditions are changing from secular bull to secular bear. So again, always watch the VIX in the context of what the major indices are doing, and particularly the S&P. But very short term, again, VIX is actually giving us bullish indications that it's finding strong support here in this 35 to 37 zone, and starting to retreat back down. Now, here's a level I want to mark and want you guys to watch, 25. So see how that was previous resistance on all of these past market downturns before the uptrend resumes. If the VIX does retreat back to 25 and bounces off of it, to me that's a very bearish indicator. and where I would look to be more aggressive on any sort of a bearish position, directional position, shorting the market basically, or taking bearish bets on a continuation of the sell-off. But again, look at that in the context of the levels that we mapped on the indices. Always important. All right, so I'll pause there real quick, see if there's any questions, Richard, and then we'll talk about the implied move and how to use that to give us some clues of where we want to, look for buying and selling pressure through the rest of this week.
No, there's no direct question. I think everybody's just really listening and paying attention. I just want to point out the fact that that's why a lot of you guys are here. Why we're all enrolled in this program, is why we started following Jeff, is because it's for times like this. For years, we've had this wonderful, massive bull market, and now we're showing signs of going the other way. And now is the time where you really need to be buckling down and paying attention to what's happening, because before, when the market's going up, anyone can be a hero. But as things are now changing tide and things are getting more volatile, this is why we're here. This is why we're so fortunate to have Jeff here. So yeah, I just want to say, as a trader, that I appreciate your insight, Jeff. And I mean, to have to go through these types of environments alone is, as we've done in the past, it's pretty scary. To have somebody here right now with 20 years experience, already been through this a few times, I mean, it's pretty lucky that we're here and being able to follow along. So I just wanted to say that out loud. A lot of people are thinking it, but that's really why we're all here, to be here and help you guys and support you and really help guide you through this process. So I didn't have any of the questions. I just wanted to put that out
there. Well, thank you so much. Yeah, and just know, like it for me at least, like it always helps to know that you're not alone. This is not easy right now. I'm struggling with, because I tend to, trade more swing trade to longer term, and then use, adjustments with hedging and things in between. But when you get a lot of whipsawing like this, it makes things really difficult for everybody. So no one's alone here. It's not an easy time. And I always tell people, like, sometimes, even though it's difficult, because it's human nature, we don't want to miss out on opportunities, but sometimes it's better just to sit it out and wait for this to give us a better idea and clearer picture of what the market's going to do over the next few months, or even through the end of 2022. And that's hard to do for anybody. But if you feel that way and you can manage to sit on the sidelines, and it's hard. It's a struggle for me too. I want to be involved, and I don't want to miss out. And but when I have sat on the sidelines, I've almost never regretted it. I've always looked back and thought, I'm glad I didn't get involved when the market was crazy, because it just makes things so much more difficult. And this is a very difficult time in the market when you're transitioning from secular bull to secular bear market. That part of the transition where things are the change is becoming more clear and apparent to more and more market participants, and eventually, of course, everyone's basically sees it. That's the part that's really difficult. It becomes much easier once things stabilize and we don't see these lows because right now we're now hitting lows from last year. So when you start to hit lows from the prior year, that's a difficult time, right? So 1 year ago today, on the S&P, we were down here at 39.23. So we're a ways off there, but on the Nasdaq, 1 year ago today, we hit that level this week. So that's, I mean, an entire year of price appreciation on the Nasdaq was wiped out in just about 2.5 months. So these can definitely create really good buying opportunities, but I think, since we don't have a crystal ball, we need to look at it in the context of things like geopolitical risk and inflation, because those things tend to be longer term and have a longer term impact on the market. And then always advocate for cautious entry. Wait for things to scale in. Don't go all in at once. Even if you're if you're highly confident that you want to get in at this price after a major sell-off, I've always found it's better to be cautious and scale in. That way that if you're wrong, you have the flexibility to add to your position at lower prices versus going all in at one price and hoping for the best. Because then if it doesn't work out, you have no flexibility. You basically set yourself up for a situation where if things don't work out, you could wipe your account out, or you could do serious damage to your account, and then not be able to do anything about it. So that's another important thing. And we're going to spend on future sessions, we're going to spend time talking more about that, how to use risk management and money management techniques when entering and exiting trades. So topic for another day, but just something to definitely consider right now, because some of these prices are pretty attractive. I mean, just looking at the price picture, 13,000 is pretty attractive on the Nasdaq. When you look at, but know that when there was buying off that level, it was at a period where there was probably irrational buying going on past the secular bull market, where it made sense to actually drive prices up where things weren't overvalued. Because I mentioned on our last session that once a secular bull market ends, there's still people think it ends when price reaches a high and then sells off. That's not actually the case. The high in the market, like on the Nasdaq from November 22nd, was not if this turns out to be the end of the bull market, that wasn't the day that it ended. It ended long before that. There was just excess buying going on because things always overcorrect and undercorrect. So once a market environment changes, you're going to get some degree of and I think I mentioned this last time. It's exactly like what the Fed does. They overcompensate and undercompensate. They wait for inflation to get out of control, then they have to get aggressive and raise rates, or they wait. Once the economy is just booming and doing really, really well, and we get inflation, they raise rates, and then once things get really, really bad, we go into a recession, or God forbid a depression, they have to then overcompensate the other way, and I mean, it just happens that way. It's like they're always playing catch up with their bad decisions, whereas if they were just more moderate and not so drastic in these situations, then, and not to say, not blaming them and saying, I'm sure it's not easy. It's just the way that things work. So it overcompensate, undercompensate. So likely we'll see, if we go into a bear market, we'll see prices get oversold to way below where the valuation is. And that's where I'm going to, start when that happens. I'll start talking to you guys on our sessions about undervaluation and good buying opportunities that could give us sustained price appreciation. So all right, let me I always stop talking. I always kill more time than I realize and look at the clock, and Haven't even gotten to the implied move stuff. So let's take a look at that. Get my chart or my platform up here. Okay, so whenever you have, and this doesn't just apply to, we're gonna look at the VIX and the S&P and the Nasdaq, and it doesn't just apply to these. It applies to any security that's optionable. It has options that trade on it. You can use for this analysis. So, and we've kind of touched on this in past sessions, but basically, when there's a major, announcement or event, and the market's getting crazy. I mean, this should really be done even when the market's not being crazy, but especially when it is. We want to look at what the options data is pricing into expected moves over the course of. It's always related to a time horizon. So. So like with individual equities, you could do this if you're expecting, an earnings release from the company, or in like the context of this week with the FOMC meeting, and probably very likely one of the first rate hikes we've seen in a long, long time. We want to know how is the market going to react to that. Now that's what the implied move tells us, and unfortunately, it doesn't tell us which way it's going to go. That would be amazing. And also, even the range is not necessarily going to be accurate. That's why I mentioned a little while ago that if this range is breached and violated, I think that was the word I was looking for before. Like if we violate this implied move to the upside or downside, then we tend to expect a sustained momentum past that price. So the first step in using implied move is we want to look at, what are we, what's the event, what's the catalyst that we're monitoring, and if we have open positions in our account, or if we're considering putting a trade on, we want to see, based on what the strategy is or the expectation or the direction that you're trading, we want to see at least what the market is pricing in terms of how much that could move in either direction. So it's really, really good information, especially with like a lot of option strategies, because for instance, like when I set up a credit spread or an iron condor, I want to make sure my strikes are out of the implied move, expected move range, because I'm going to be much, much less likely to run into trouble. So there's two ways to do that. If you use Thinkorswim, it's provided to you and on the right side of the options chain, where you hover over and it says implied volatility here on the right. And it gives you that for each expiration. So right now we're looking at the VIX options expire every Tuesday. So today's Tuesday, so it'll be, this one's 7 days to expiration, the new contracts, which is fine. So, if we were looking at a stock that had weekly options, we could look at expiration Friday this week. But we want to select an expiration that encompasses the catalyst or event that we're, curious about in terms of how it's going to impact shares of the equity or options, or basically the move of the underlying. So right now, in terms of volatility, the market's pricing in a 5.3 move to the upside or downside on the VIX. Okay, so again, that's not a and that's between now and March 23rd, not necessarily between now and tomorrow, but that would be the upper and lower limit, including the events of tomorrow. So the other thing that Thinkorswim provides is this figure up here. It has the 3 M's. I think it's like money market move or something. That's a separate implied move that is provided based on an upcoming announcement or event that doesn't coincide with an expiration on the options chain. So that's what you see up here. This is I would almost guess, certainly is based on the FOMC meeting announcement tomorrow. So that's telling us that they're expecting a move up or down of a little over 3 points on the VIX tomorrow. That's not really big. I'm surprised it's not more. So I wouldn't be shocked if this gets breached. But what that is telling us is that like I said earlier, it's probably priced into the market, unless there's some major diversion from the expectation or what the Fed has said they're going to do. It's probably going to be a 1/4 point basis hike. So that's telling us that that's very high probability, and there's probably not going to be as much volatility if that is the outcome. So that's what that tells us. Now, if you have a different platform or don't have a broker platform that gives you the implied move like Thinkorswim does, you can quickly run a rough calculation by using the at the money put and call options. So right now the VIX today it closed at 29.83. So the closest at the money strike is 30. And you would just want to take the midpoint between the closest to the at the money or closest to the money strike for the puts and calls and add them together. And you're going to get, so like the midpoint here is about $2.15, and midpoint here is about $2.85, 90 cents. So that's going to give you a kind of a quick and dirty estimation of the implied move just by adding those together if you don't have a feature in your platform that gives you that number. So so that's the implied move for the VIX. Now let's see the S&P and then the Nasdaq, because of course the Nasdaq tends to experience larger price swings than and the nice thing, oh, by the way, yeah, the nice thing about the some of these indices and even individual stocks is they have more flexibility with expiration dates. So we can see that also with near-term expirations. But so we can actually go out to tomorrow's. Let me see what yeah. So interestingly, actually, their expected move, their money market move, and I don't pay real close attention to this one because it's that's actually a proprietary reading from Thinkorswim. It's as far as I know, it's not something that's available. So that's their own kind of proprietary expected move gauge. So I don't know how they calculate it, and don't necessarily put a lot of weight in it. What I rather really look at is the implied move at the expiration. So if we go out to like tomorrow's expiration on the weeklies for the S&P, we've got a 58, just under a 59 point implied move to the upside or downside. All right. So once we know that, and again, just to emphasize, we can go out to any expiration and find that, right? Say we want to know a month from now what the implied range is for the S&P. Well, it's 289 points up or down. So here's where you can really get an edge, in my opinion, is taking that information. So again, tomorrow, 58 points, right? And then going back over to your chart, go back over to the SPX, and using that implied move information in conjunction with your visual support and resistance levels. And again, this is very near term, but at least it tells us if we see that implied move line up with a major resistance area, for instance, and we were to take a long position off a positive reaction to the FOMC meeting announcement, then we would want to look at that as a profit-taking level. So, the close today on the S&P was 42.62, and what did I say, it was 58? 58, right? So if we add 58 to that, we're looking at, I got to do math here. What, like 43.20 or something? Is that right? Let's see, 70 would be 50. So yeah, 43.20. Tell me if I'm wrong there, but I think that's what it is. Just did that in my head. I'm not real great at math. So 43.20 is the expected, if there's a positive reaction to the meeting tomorrow, is the expected ceiling on the range of trading for tomorrow. And that does coincide with some strong resistance, right? So support there, of course, but remember, when support breaks, it becomes resistance. So now this is our resistance. According to option statistics, implied moves statistics, and past buying pressure that broke and then became the support became resistance there. So that's our ceiling for tomorrow. Now, if that breaks tomorrow, if we close above that level, very bullish, near term bullish, not long term or even medium term. But that's where our buying opportunity could come into other levels of resistance. Now, to the downside, I mean, we had a really wide range today. So, we're only looking again at 4,200 support, but has bullish implications, right? Because our implied move is actually not even below the close from today, because the close on the S&P was 42.62. So if we take that 59-point implied move, we're not even below the low from today. And there's that 4,200 level right there. That's also our horizontal support. So there's more weighting to bullishness on this implied move for tomorrow. Again, not by any means a guarantee, but we're only looking for an edge here to get clues about what the market might do. And then on the Nasdaq, of course, we're going to see larger implied moves. Let me get back over here. All right, so we have a large implied move for tomorrow on the Nasdaq, but it's not as large as today. We had a 411-point move to the upside today, with an implied move for tomorrow of 265 points. And so that's why this could open up an opportunity too for us if these implied moves are breached or violated, because on a closing basis. So we'd want to see a close past that implied move at the close tomorrow. So, if you can be patient and wait for a close past one of these implied moves to the upside or downside tomorrow, that could be a high probability, very short-term trade for Thursday, Friday, the rest of the week. But 265 points on the Nasdaq is the implied move there, right? Through the expiration of these contracts tomorrow. All right, so that's a 265 points. We're looking at 6, up a kind of right, sure enough, where we marked that resistance area around 13,750. So that's going to be our resistance area to watch. So that's, hopefully you guys understand like the confluence I'm looking for here with, first step being map these levels out visually, see where there was buying and selling pressure or support and resistance, and then see how that aligns with implied moves over your as part of your trading plan over the expectation of your trade. So like, if you're planning on just trading the Fed outcome, and let's say your trading plan is wait for tomorrow, see whether the market is able to push up past this resistance zone and implied move tomorrow, or below the support zone and implied move for tomorrow, and then take a position in that direction for Thursday, Friday. Like if it's that short term, this is what can, give you that clue. So that's our implied move on the floor, on the ceiling, and then on the floor, we're looking at let's see, 13,200 roughly on the floor. So again, major support, right? Even though these scenarios can be kind of frightening and unpredictable, especially in terms of how the market's going to react, by running through this type of exercise and doing your homework beforehand, it can actually give you a lot of comfort and confidence, knowing where we're looking for buy and selling pressure, resistance, support, and giving us a clear picture of where prices could go over the nearer term. So ran a little bit longer on that than I had anticipated, but I think I hope it was worth it, and it'll help you guys navigate the rest of this trading week a little bit better, which is why we're here and what I'm hope to help with. So even though we ran a few minutes over, I still want to keep my promise and give you guys some time to ask questions, and then if there's any particular specific symbols you want to look at, we can do that too.
Yeah, there's a couple requests for symbols. Could you look at Alcoa AA for Shaw?
Yeah. Okay, so yeah, it looked, just purely looking at our levels and kind of overall sentiment on this, it's had a big run up, right? So this year we've seen price appreciation from around 57.50 all the way up to 92, 93. Major rejection off of this, right? That's not my arrow. So this is our really bearish candle. And just kind of like, I always try to like talk to myself in terms of like telling a story when I look at candlesticks or the price action. Yeah, you see, I see bulls are really like getting overly aggressive here at highs in Alcoa, and then there's this squeeze where the bears come in and drive it down, and those are very wide range high volatility candles that resulted in a short-term sell-off. But we do see support here at 70 that seems to be quite strong. We had a sell that triggered from trade trend there, and it would have been just below the low here. So right now, even though our trailing stop is still rather high up, because we reached this major support at 70, and if you had taken a short position on this, there would be an open profit on it. Not a big one, but if you hadn't mapped out the 70 level beforehand and saw it as a support from back in later February, could have been a good profit taking level, or at least a place to unwind a portion of the position and move your stop to break even. I see probably a potential for near-term rebound, being this level. 70 seems to be significant, but on the flip side of that, if 70 breaks, we don't see much support until down here around $63, $64 a share. So again, that's major resistance from back in January. So if the 70 level holds, then probably bullish up into 77, or even 80. But if 70 breaks, then bearish down into the 63, 64 level. If that breaks, bearish down into 52.50. Let me actually look at this one from back here. Let's actually say 57.
All right. Let's see. Stephen wants to know, has oil broken below support the last few days?
Yeah, so I mean, the oil markets have been crazy. I haven't touched this with a 10-foot pole. I mean, I wish I had bought, and had a really nice buy, trade turn buy signal back in December at a major support. And I didn't do a lot of oil trading. I have traded it, but I haven't traded at all this year, or maybe even last year. So unfortunately, I missed this, but it's had a huge run up, and of course, a lot of this is due to the conflict with Russia and Ukraine. But then it hit a ceiling around 130 and has had a huge reversal. So the high, let's see, was it on 3.7? Was at 130.50, and it sold off into the 95 level, which is in like 6 days or something. But sorry, I was watching the futures on my other screen. So 95 is definitely support. Here, actually, just kind of from a candlestick analysis perspective, this is I like these. I don't do like much trading just purely based on a candlestick pattern. Definitely not just by itself. I would have to use it in conjunction with other things like support and resistance. But what's interesting here, these can actually be good candlestick patterns if they play out. And there's, I'm sure, a name for it, but I don't have them all memorized. But there's the support. Let's see. All right, so we see some major resistance here, of course, right? But then support there. And what's looking like support here, but 95 major to watch near term through the rest of this week. But what I was referring to in terms of candlestick is, and again, I don't know what, maybe some of you guys might know what this is called, but so you get a wide range candle, and this goes either way, but we're talking about a bearish scenario here. So we have a big bearish sell-off, then, and of course, we would have to wait until tomorrow to see if this actually close this way, because this isn't a closed candle for today. But if it closes with a narrow range towards the low, and it's an inside candle, meaning that the high and low of the candle is contained within the high and the low from the previous day, and that breaks down, that is very, very bearish, especially off a support or resistance level. So depending on what happens with this candle tomorrow, and this will close tomorrow, I think it's 6 p.m. Eastern. And then that ends up being the case, then, it might be good short opportunities here, but there has been a lot of sell-off, here, obviously in oil with potential for a rebound. So long-term, medium to long-term, I'm bullish on oil. I think we're going to see prices continue to go up, and there's a natural rise in the summer anyway, right? Because of increased demand. We tend to see increases in gas and oil prices. So seasonality wise, that's the case. But obviously what's really driving all this is Russia and Ukraine. So, as I mentioned, that most of that hasn't been priced into the market. This is a lot of this stuff you're seeing is just emotional reaction. We really don't know what the full impact is going to be. So that's still to be determined. But if 95 holds, I expect, and I think, medium to longer term, we will see it trade higher again. But near term, if it breaks 95, or if it forms this inside candle, and we were to take a short, lower prices potentially ahead. Now, in terms of trade trend, we had a sell signal on was it 3.7 or whatever, 3.9. And then a trigger here on day 3. So entry would have been just below the low of the candle here. So that this sell signal is actually still open. There's an open signal here to the short side. But just like we looked at with Alcoa, this is where 95 might be where I would look at potentially scaling out if I have a short position, and then moving my stop to protect it, or just taking profits altogether there and waiting for the next opportunity. Or, if you're more aggressive and you think there's going to be more of a medium term sell-off in oil, then you could follow the trade trend algo trailing stops. But that's kind of my analysis on oil here. I think the volatility is going to continue. And again, another key takeaway is we haven't seen the full impact of the Russian-Ukraine crisis, and that is definitely not fully priced into the markets, including oil. I see Omar's asking for Facebook. Let me look at that one real quick, and then we can wrap up with any remaining questions. Yeah, so, as we looked, I think we looked at this one last session. Obviously got hammered on their last QE, but it seems to be basing right at this point. Let me see if I can zoom out a little bit and get a clearer picture longer term. Okay, because shares have just been hammered. But there seems to be some basing here around like 190. So I want to draw my level from there and see if it's really coinciding with anything significant over the past few years. I'm not seeing a whole lot in terms of, that we had some area of resistance there, but otherwise not a lot of real support or resistance around that level. So we're seeing some basing, but it's not a lot of a conviction behind it in terms of past buying or selling pressure. And it's one I'm staying away from. So I'm not touching Facebook. I don't know, where it's headed. If I were to become a buyer, it would probably be more down around the 140 level. As we can see, there was a very strong buying pressure off that level and a huge move from there. So I think Facebook, probably has more room to fall. But if this 190 holds, and certainly, if it can close back above 200, that would be probably more near to medium term bullish up into strong resistance around the 240 level. So, any long positions, I would look at a 240 for resistance. On a break of the 190, I would be looking for support around 140, which if I were to become a buyer of Facebook would be a level I'd look at potentially starting to scale into some shares. But yeah, stocks obviously been hammered pretty badly. And also look at, a nice thing is Facebook has weekly options available on them. Look at the options chain and the implied moves. If you're trading Facebook or considering trading it, definitely want to check the implied moves in the options chain to give us a clue whether you're very short term or more medium term or even long term. A lot of these stocks have leaps or long term options available on them. You can go out, a year or more and see what the implied move is. And if you can find that implied move off of a strong support level, that can give you some really good indication of prices that would be favorable to buy the stock at. So definitely want to use that. All right, let's go ahead and see if there are any questions before we wrap up for the night.
Ed got a question. He said a great option instruction on toss. Any comment on using volume by price? He has.
I think that came up last week.
Oh, okay.
Yeah, good question. Yeah, we talked. That was Ed that was asking that.
Yeah.
Yeah. Ed, I guess last week we did we hosted Steve Bigelow. So it was week before. But our last session, Ed, we did cover that a little bit. Volume on price. And yeah, again, not in my opinion valuable as a standalone tool or indicator, but can be with especially when using conjunction with the horizontal support and resistance levels that we've been doing together. So if you can find, the nice thing about, for those of you who don't know, volume on price is basically showing you, normally you'd have volume like here plotted down below, and it's showing you volume by day, basically. So whatever the volume for the day was, whereas volume by price is showing you the volume at a certain price level. So if you see increased volume at a support level, that could be further confluence of, buying pressure. Conversely, if you see high volume or increasing volume by price at a resistance level, that could be more confluence for, selling pressure. Is that good? Does that answer the question?
Yeah, he said he was thinking it might be a confirmation if it coincides with implied moves.
Yeah. Certainly. Yeah. You can use it with a lot of other things, implied moves too. Yeah, for sure.
That's it.
Cool. All right, guys. Well, good luck tomorrow. I hope everyone, weathers the storm. It's always better to be cautious and sit on the sidelines if you have any concerns, but hopefully what we covered tonight will give you guys a little bit more confidence for tomorrow and the remainder of the week and into the future. And I hope you got a lot out of it. We're always here for you. If you have questions, email us at support@altostrading.com. And we will see you guys next Tuesday. Have a great rest of the week and great weekend.